podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to the Hedged Edge by RCM Ag Services, where we're getting out of the field and onto the mic to bring you weekly market updates, commentary from commodity experts, and monthly interviews with the biggest names in agribusiness. Welcome to the next episode of the Hedged Edge. I'm your host, Jeff Eisenberg. It's no secret that commodity markets have been on fire over the last 12 months. On today's podcast, we brought on one of our real-life firefighters from RCM Ag Services, Jody Lawrence, along with Tim Andriesen from the CME Group, to provide us with some inside baseball knowledge on the current state of the agriculture markets and to discuss the real-world application of the use of short-dated options to potentially fight the current blaze of volatility surrounding ags. As Director of Research for RCM, Jody is no stranger to the podcast and is a huge asset to our team. Tim is the Managing Director of Agriculture Products for the CME Group and is responsible for management of the company's global agriculture commodities business, including grain, oilseed, livestock, and dairy risk management products. Welcome, gentlemen.
It's great to be here.
Thanks for having me, Jeff.
Okay, so, obviously agriculture markets right now are very exciting, guys. So now that we've got, the two experts on the line, I'd love to just kind of take a quick spin, over the current status of markets. We're talking a very exciting time for agriculture producers who've had the ability to, see a impressive run up in price and hopefully start to add some hedges and get some hedges in place to lock in some nice profitability and margin for their farms and their operations. But it's a lot of unknowns out there. We've just come through. We had a June report beginning, then we had the crop and acreage report at the end of the month, and then next week we have yet another USDA report. It would be great, Jody, if you could just give us a quick synopsis of where the markets are today. We've had a rally up, a sell-off, a new rally, and a new sell-off. Just give us perspective from the farmer side where things stand, and Tim, if you could add to some of his comments, that'd be great.
Well, the biggest thing, if you go back a week from today, was the June 30th acreage report, a week from yesterday. And it was a shock to the market that the acreage numbers from the USDA came in lower than expectations, because there were a couple very, very high private analysts, and I'm not going to throw them under the bus in this forum, that came up with some just completely unrealistic numbers that a lot of people involved in the market got spooked into believing, and drove the price down going into the report, even as outlying data would show, and ultimately verified by the USDA, the acreage simply can't expand just because price goes up at the extent that they thought. And then when the acreage came in just a little bit higher than what they came out with their March intentions report, the corn went from trading down 20 cents to limit up within just a matter of moments after the 11 o'clock central report, was even higher the next day and got within about 10-15 cents of the contract high that was set back in May. In the mid 630s. So, and then subsequently heading into a long 3-day weekend, right when everybody was beginning to feel good that they had, understandable landscape and market in front of them, with hot, dry weather in the Dakotas and Western Corn Belt. Then they got a crack in the forecast, and late Thursday and into Friday, heading into the 3-day weekend. And then the next thing we know, all of a sudden, hot and dry became cool and wet for the next 10 days. And Tuesday and Wednesday, the rare overnight opening of the market, we didn't open until Tuesday at regular time at 8:30. Corn fell almost immediately to limit losses, and then has added to that. And beans gave back the entire dollar, 90 cents to a dollar, just simply on the news. It was just an avalanche and waterfall of selling of people who probably got poorly positioned on the way up after the acreage report, and then got margin called, or were going to be margin called right out of it. So just like everything else in life, and the example that I always use is when you're talking to your kids and there's just a dispute about who did it. The truth is always somewhere in the middle. And, is corn fairly priced at December corn at $5 or at $6? It's probably $5.50. And who knows where this is, but excuse me, just the crush of volatility, especially two-sided volatility. It's something that I don't think I've seen in 4 trading days, the swings of such momentum and such viciousness and volume ever in these markets for what previously, not in a post-COVID pandemic, relatively high price year, would have been historically probably much milder differences, but we are where we are. And when you add $1 one week and quickly take it back the next, there are certainly a lot of open wounds, and there's a lot of scar tissue with a lot of traders right now, just incredibly frustrated about how and where and who's driving the market these days.
Yeah. Tim, what are you seeing from your side? The obviously the surge in volatility and volume, is it largely driven by the farmers, the commercials, the funds? What are you seeing?
What we've seen is continue to see the same kind of players in the market that we have for a long time. I mean, the commercials still take up about the same share of the market that they always have. But clearly what you do see is we're at a place where people are trying to make risk management decisions, whether they're, buying grain from the farmer, or they're the farmer selling grain, or they're somebody trying to trade the market. And, when you're seeing pretty toppy prices, people want to get it sold. And when it looks like it's going to go away, they get much more aggressive about getting it sold. The one thing that we do see significantly is just a huge increase in the use of options for this exact reason. I mean, the challenge you have if you're sitting there going, well, I want to hedge and I don't want to sell it to the elevator because, I think the basis is going to do something. Even if you're scaling up using a very prudent marketing strategy, in markets like this, you can potentially have significant margin calls because it could significantly go higher. So a lot of people that are looking at that are saying, well, the best thing I can do is let me buy puts, or at least if I'm hedging, let me turn around and buy calls against that, and put myself in a position so that if the market continues to go up, I can benefit from it, or if it goes down, I have some protection.
Yeah, that's a great perspective, Tim, because there's 2 sides to every coin, and the ability to buy and sell these options and protect yourself is paramount to the capabilities of the farmer, and what the exchange makes available to the risk managers. The interesting question comes up is, we've seen a huge rise in volatility, and in effect, the cost to put on these hedges. And so, as we've worked on our side with farmers and elevators and the people that are needing to physically hedge these commodities, the use of the short dated options has become even more important than ever. And we, from our perspective, you can go up and buy $6 calls if you're trying to re-hedge in December for, I didn't look at it right before we started, but maybe it's 40 cents. Maybe Jody could pull it up while we talk. But the short dated options might be expiring in a few weeks or a month from now on that same December contract, but be half the cost at the current levels. So, a farmer or an elevator might be able to get themselves through, this report period, which we've just had a major one. We've got another, plus the pollination that's coming. Do you think that has been a reason for the rise in volume and use of those options?
Absolutely. It's interesting. At the beginning, you kind of asked me what my background was. And when I joined CME, I had just spent 10 years on the OTC side of the business, where you can pretty much come up with whatever product you want. Right. And one of the things that we saw a lot of demand for were shorter dated options, were things that are very, very similar to the short dated new crop options. Hey, listen, I don't really need protection between now and November on corn. What I need is protection for the next couple of weeks. And because, I'm concerned we're not going to get through pollination, or I'm concerned that there's a report coming out or something like that. And so one of the things that we did at CME is say, well, look, these are the kind of products that, if you're a sophisticated player, maybe you can go do this trade with a bank, but we want the farmer to be able to do these same kind of transactions. So we launched short dated new crop options and then later weekly options for exactly that reason. It's important to remember, and you guys know this, but just for some of the listeners, options are always priced right. I mean, if options are really expensive, it's because volatility is very high. And there's no way you can, change volatility. It's driven by the marketplace. So if volatility and the time that an option exists are the two parameters you have, the way that you reduce the cost of the option is shorten the time. And so short dated new crop options allow you to do that. Hey, I don't want to spend a lot on an option, but I think if I can get through the next month and a half, we're going to know where I am. And, that's the protection I need. Or look, we've seen responses from two reports. Man, whatever the next report comes, are we going to see a big move again? Maybe I have something sold and I want some protection against that. So I'll look at buying a weekly option. That's the mindset that's been driving this. And what I'll tell you is short dated new crop options are in June accounted for 14% of our business, which is, the biggest number we've seen in quite some time. Yeah. Weekly options accounted for another 4 or 5%. So, 20% of our business has been these short dated options, where people are taking this mindset of, I want protection, but I don't necessarily need to buy the vanilla option to do that.
Jody, I mean, your customers were probably half that volume, right?
I would make an assumption. Tim, I do have a question about that I know my customers are curious. Do you have a pool of market makers in this? Because obviously the volume, if I have somebody that puts in an after hours order at night, the weeklies and even the short dateds, the bid offer becomes, much wider than it is during the day. Who are your natural pool of market makers? Who are the sellers of these options that my customers are buying?
That's a really good question. A lot of times people go, what do you do? And what I would tell you is our job is to try to manage that ecosystem. And so when it comes to options, there are market makers. There are firms whose whole job is we make markets and options. And, they specialize in making sure that there's a two-sided market with X amount of depth. and just like back when, you had locals doing it, it's now being done electronically, but there's a much broader range of options they're making markets on. So we do have market makers who are in there who are doing this. To your point, they're not as active in the evening. We do have a significant amount of business that comes overnight. As a matter of fact, we've set a couple records in terms of our overnight business from Europe and from APAC. We're seeing significant growth there because those people are seeing the same markets, and consumers in those markets have the same need to manage risk. But yeah, there are market makers who are in there that are making markets and options.
Yeah, and the way I explain it or the way I try to explain to everybody who's not familiar and watching this with options is, if I'm a seller of the option, I have to get a high enough price to justify the fact that I am taking an unlimited potential risk against a limited reward. If I sell a $5 December call for 20 cents and corn goes to $7, then I could be out $1.80, whereas the buyer of that call only has the initial 20-cent risk. So what we try to do is educate people just as much as anything, and knowing who's on the other side of that will help all of my customers watching this understand that there are people taking on risk, an unlimited amount on one side, that they clearly have to offset sometime or at some point. So that does help. And the fact that they are liquid, and just the availability now that you can get a weekly option or a daily option to within a 3/4 cent spread on the bid offer is impressive. And y'all have done a great job with that, because it certainly, it shortens the runway and adds to the adds to the market sensitivity and the delta of what happens with these reports, as opposed to saying, well, you still have 6 months till it expires. Sorry, you only made 20% of how the market moved.
Yeah, and Jody, you're spot on. I think when people are looking at options and looking at option prices, if you put yourself in the shoes of the seller, which you just explained, that's the best way to understand why pricing does what it does. More volatility, longer time, more expensive options, because they have to, manage and take on that risk. And that's why these products are less expensive, because on one of those parameters, the time, you're shortening it down and making it more precise in terms of how you can use it.
Yeah, I think you're really seeing that growth because of the education that people like Jody are doing, people like the firm CME is doing, and it's going to continue to grow. I mean, the between the short dated new crops, the weeklies, a question I had for you before we move on to tracking some of that volatility is, did you happen to see the data leading up to the report? I saw a note that you had some of the largest open interest growth there was June 24th. So 6 days before the report. Has that been a common thread over the last few months, as the uncertainty of what the USDA is going to be publishing and talking about has come into play in these markets?
Yeah, you definitely, if you look at specifically the shorter dated options, what you're seeing is people build up positions going into these reports.
Right.
The weekly options, you've seen really strong growth where people are putting those on, going into the report. Short dated new crop, going into this window of uncertainty that we're in right now. We've seen a lot of people build up open interest exactly for that reason.
Right. And even over the weekends for weather related situations, I mean, with Jody said at the beginning here, basically all intents and purposes, a 4-day weekend and unknown weather, I would imagine you saw weekly option volume go up going into something like that.
Absolutely.
It's gonna be interesting to continue to track and to see what other products end up coming on. I mean, it's available right now in the main grains. livestock as well. Is that accurate?
No, livestock, we don't have the same kind of seasonality in livestock. And honestly, I think you see a lot more usage of options in grains. I think that, because you have a situation where, there's certain windows which really drive whether or not the crop's going to get delivered or not and produced or not. You see a lot more people that are focused on using these kind of tools. And the other thing is I give credit in two places. Number one, I've been around the world and looked at different marketing systems. In the U.S., we probably have more opportunities to do things with the local elevator than any place else in terms of the products they're offering. And number two, we probably have more good folks like you guys who are working with a producer, helping them understand how to use the products than any place else. So I think both of these have really driven the growth of these products, and in particular in the grain sector versus livestock, where you really don't have people that are like yourselves that are as active in terms of helping to educate people and work with people to develop effective marketing plans.
Yeah, well, that's a good, interesting perspective too. So we'll continue to track along with new market developments. But the thing we want to come back to is you mentioned, the ability, the rise in volatility of these markets, and then as Jody said, there's going to be people that are willing to take the risk on the other side. The CME came out with the C-Vol index, which allows for us, being the public, to track along with the growth and changes in volatility, so that whether you're an elevator, a producer, or a speculator or market maker, kind of have a historical benchmark as to where volatility is on these markets. Maybe if you could just kind of comment on these on this index that you've created, and practical use for it. I guess, where can we find it too, so that people can get it in their hands, because it's a great tool that we use.
Yeah. So the whole idea of these volatility indexes is that, the markets, if you think about implied volatility is the volatility that you can derive from an option, and it tells you about the volatility of the futures contract. If you look at the skew, you look at, our calls trading at a greater volatility than puts. If you look at where the absolute level is, all of that is useful information for you as a marketer. And it's not just, do I want to be long options or not long options? It's also, what is the expectation, the future expectation of the marketplace? So what we've done is we've launched C-Vol, in the case of corn, which is a 30-day forward-looking implied volatility of the underlying futures contract based on that data that's taken out of the options market. And you can go to the website if you really want to get into the geeky part of how exactly we would calculate that. But the general idea is that measure gives you a sense of what the volatility is that the market's looking at, and you can then also compare it against past history. So, for example, corn C-Vol hit 56%, which is a level that we haven't had since 2012, and we all know what happened in 2012.
Right.
So, as we look at these things, it becomes particularly useful for us as we're thinking about marketing, as we're thinking about how volatile things are, and as we're trying to compare different strategies period to period.
Yeah, and I think that's going to be something, to try and get in the hands of more people to understand what it is they're paying for, particularly from if you're an elevator or a producer, you're saying, well, why is it so expensive? And you ask this question yourself each day, each week, or, leading into the report, and then you could point back to that, and it shows. You see an increase in open interest. That means there's more buyers and sellers of these options, which obviously drives prices. And then you've got the index to kind of point back to. So I guess, are you planning to, I guess, how are you making it available to people? Just going to the CME website, go to the CVol, or search for it in Google, and that's where you encourage people to go to use the tool?
It is on the CME website, and I'm trying to find it.
We'll make it
But
available.
It definitely is on the
show
CME
notes.
website, and we can get you the URL for it.
Yeah, we'll make it available in the show notes for sure. And you know, it is a nice tool when you click through it. So um, that's great. So I guess, you know, as we start to look ahead, we've got the next few weeks, you know, of July pollination going on, then, you know, we're going to start getting to a sense of where the markets are, how much actual acreage we have, some yield numbers, weather. I guess, what are your thoughts on volatility from here? Are we, you know, going to start to continue to see, you know, these high elevated levels? Is there something in the data that's showing you one way or the other?
Well, I mean, CVol kind of looks forward, and it certainly is saying that there's a high level of volatility going forward. As far as, you know, will these be sustained or not? I mean, that's probably a question Jody can answer better based on what, you know, his perspective of the fundamentals are. I would say that, you know, if you look at what fundamentals are, we're not going to go back to where we were a couple of years ago, probably. We're always going to be, or at least for the next couple of years, in a situation where we're going to have volatility and where risk management is going to be pretty important.
Yeah, and I think another thing too is, as these farms have continued to grow, and, you know, our farmers have done an amazing job in our country of kind of building up their own storage facilities. My guess is we'll start to see some of these the option use and risk management being deferred beyond just December. You know, we're looking at March, and then, you know, into July next year. So, Jody, what are your thoughts? Historical patterns, we start to see things slow down a little bit, typically August, September, volatility.
Historically, yes, but we saw what happened last year, because middle of August is when this whole thing started. When you start kind of layering on everything that we have, the perfect storm of record losses to Brazil's corn crop, the U.S. off to a sketchy start, and hard to define start, going into the 4th of July, and record world demand as we emerge from COVID and China comes out of their ASF disaster, and all of the things trying to come together. The volatility, I suspect, will stay around a while, because the wild cards, and I'm not sure anymore what's the wilder card, whether it's the weather or whether it is actually what China tells us they're going to do, as opposed to what China does.
Right.
And you get one ag attaché comes out and says they're only going to import a very small fraction of corn of what they did previous years, and then you have another ag attaché come out and say, well, we're still on pace to honor the 35 to 40 billion in the phase 1 trade deal of Chinese purchases to U.S. ag. So those two things, the weather will become less and less significant once you get to full maturity of the crop. So let's just call it September 20th. If we don't have an especially early freeze on the late planted part of it, the weather, in 2 months will be much less significant than it will be over the next month. The next month we will be going, simply because our margin for error, world and domestically, on corn and bean stocks is so razor thin, that we'll be living from half hour to half hour with each new forecast of the major 6 or 7 weather forecasters that get everybody's attention. So I don't think the volatility is going anywhere. And then we just start the cycle all over again if the U.S. ends with a good but not bumper crop. so that we still have some supply stress that mandates South America, Argentina, and Brazil get off to a good planting start come, our fall, their spring, October, November, then, we could be in this cycle for quite a while. The only thing that would get us back to, historic levels and flatten the volatility incredibly would be monstrous yields from the U.S. A well above trend, a 2 or 3% above trend in corn and beans, a 182 and a 53 bushel per acre yield would be the kind of thing that you could put out a fire very quickly in the volatility sector, simply because we would go from an acute lack of supply to a choking overabundance in the course of, potentially 6 to 7 months.
As long as we don't go back down to $3 corn, I think we'll be okay.
Yeah, it's hard to believe we were talking about that 52 weeks ago,
right.
This week, as a matter of fact, because corn was trading. I think this was about the first week where it started significantly falling below 360, and that just goes to show you where in the big picture of the world and where demand is, and if you just take COVID and that break out of it altogether, that the world is demanding more and more and more bushels from every acre to feed the growing world population, that now, because of all the stimulus money and the printing presses all over the world at all the reserve banks, there's an oversupply of money chasing a limited amount of product. And this is evident in the housing market, the land market. We know what's happened in lumber. To see that price go up, almost tenfold, and then to crash back to where it is, that it's still high priced, but it's had the haircut that it has. So you have a lot of factors that, wild card, what happens in a lot of market chatter today, Delta variant comes in, and we have a big second wave that happens once everybody, once Ohio State and Clemson and Alabama pack their football stadiums the first week of September, and everybody goes back to a Bears and a Titans game, that next thing you know, come October 1st, we have a secondary wave of Delta variant or whatever the case is. So still a lot of unknowns, but as far as the volatility is concerned, the thing that would end it very quickly would be the U.S. pulling out of this with great weather going in and a spectacular finish to the crop year.
That's great perspective, Jody. So thank you for that. Tim, did you have any other comments that you want to share market-wise before we wrap up?
No, I mean, I think Jody did a great job of outlining all the factors that could drive this market, and it's about the uncertainty that we're dealing with right now, and it makes marketing more difficult. It makes looking at options, probably something you want to do more than futures if you're a producer. So these are exactly the conditions where they make effective risk management tools.
Yeah, well, we're appreciative of the opportunity to have had you on today. I think we're not allowed to make predictions on these things. Compliance doesn't approve of it. But since Jody brought it up, he did bring up football, Bears, Titans. You got to ask, let's go for it. Who's going to be in the Super Bowl? Is it we got a chance? Tim, is it Bears? Maybe. What do you think? Are you like?
Yeah, no comment.
What do you think? We got Justin Fields. So I live in Ohio, so we're big fans.
Well, let's put it this way. One of the things that you learn if you live in Chicago and you're a sports fan is how to be an optimist.
That's right. Yeah. So it's, we've got the 85 Bears and, the Jordan era to hang our hats on.
We had a Stanley Cup in there too. So let's not forget that one.
And World Series. So,
Yeah, and the Cubbies. I mean, it happens. It just doesn't happen enough.
That's good. That's good. Jody, Titans, how they looking this year?
They've pretty much gone all in because they went and got Julio Jones from Atlanta. And, we've got the two-time returning leading rusher. We've vastly improved our defense and offense. We're going to score 30, 35 points a game. And, good on you if you stop us, because the weapons that we have, the AFC Central is going to end up looking like an old Western Athletic Conference football game. We may end up with a lot of 63-60 type scores and like a kids flag football score. But no, I think the Titans are in a good position, and Browns, and it's going to be an interesting year. At least it'll be. It sounds like I'll have a more vested interest in the Titans than Tim is going to have in the Bears on their Super Bowl chances, at least.
Yeah.
Good deal. Well, we appreciate both you guys coming on. Jody, we can obviously always find you on our RCM website. Tim, where's the best place to find you or get in touch if we would like to, any of the followers or listeners would like to get in touch with you or the CME on any of these products that we talked about here today?
In general, if you want to talk to myself or the team, it's agriculture@cmegroup.com.
Okay. We can always follow you guys on Twitter. Is there a specific ag?
On Twitter, on LinkedIn, we both have, I think if you do a search, you'll find we have sites on both of those.
Perfect. Great. Well, we'll get all those grabbed and get them in the show notes as well. But again, really appreciate both of you guys' time today, and we're really wishing everybody the best of luck into the next few weeks, and through all this volatility. Let's keep navigating it. So, thanks, and enjoy the rest of your week.
Sounds great.
Tim, thank you. Jeff, thank you.
The Hedged Edge is brought to you by CME Group. CME Group is the world's leading and most diverse futures and options exchange. For more information and educational resources about futures and options, visit cmegroup.com.
You've been listening to The Hedged Edge. Links from this episode will be in the episode description of this channel. Follow us on Twitter at ag_RCM, like our Facebook page under RCM Ag Services, and visit our website to read our blog and subscribe to our newsletter at rcmagservices.com. If you like our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear them.